there's two very important theories that exist in the market. One is what's called the efficient market hypothesis, the idea that markets are ultimately capable of incorporating and reflecting all of the information that can be known at any particular point in time. Even those who have insider information, it's presumed that they influence the market slightly by buying shares, pushing a stock up slightly, creating conditions under which, by and large, the market is going to be the best average guess. Now, one of the conditions for the efficient market hypothesis to be true is that under what's called, and I'm going to be very technical here, under what's called the Grossman-Stiglitz paradox, right, which refers to two researchers in the early 1980s, one of whom I studied under, the other one I did not. The expectation is that markets will reward the accumulation of information, and as you position yourself, you're going to influence the market. But one of the things that's required is that markets are highly elastic, and that the vast majority of players are of roughly equal size, what's called endowment. Now, that's no longer true, right? Nothing remotely close to that is true. And that's given rise to a competing theory of markets in which, instead of information, flow becomes the dominant feature. This began to emerge in 2020 with the publication of a paper called the Inelastic Market Hypothesis by Xavier Gabbay and Ralph Koyijan. Gabbay is at Harvard and Koyijan is at the University of Chicago. Their analysis was that markets are actually not super elastic. In other words, not capable of absorbing flows with very little change in price. In fact, they're highly inelastic. In other words, when you try to buy and sell, particularly if you do so in size, you're going to change the underlying market behavior. Just to give an idea of how off balance these two competing theories are, or how much they stand in contrast to each other, the efficient market hypothesis through the Grossman-Stiglitz paradox presumes that $1 into the market, because it also represents $1 that somebody is selling, has a de minimis impact, basically 1 penny change in market cap for $1 that tries to go in and buy. Under Gabbay and Koyijan's work, their estimate is that's more like $5. So in other words, the inelastic market hypothesis suggests that the efficient market hypothesis is misspecified 500 to 1, right? That's a huge change. It's revolutionary in its implications, and is why firms like Tier 1 exist, to track these flows. And others who are doing similar work are doing so largely in the institutional space. But for us, it's really important that people understand that the world that we inhabit today does not really resemble the world that we were taught existed, that these flows really matter. And so we're focused on trying to monitor them, predict them, and understand them. Anything you'd want to add here, David or Craig?
Yeah, well, Mike, actually, I have a question for you, and I think I already know the answer to this, but what drives markets to be inelastic, and how does passive kind of play a role in this?
Sure. So there's a couple of things that are very, very different. So one is this question of endowment, right? Or how big are each of the individual players? So when you start thinking about, your average hedge eye investor and their self-directed account, don't take this the wrong way, but only very few of you are meaningfully going to affect the market. But when you aggregate all together, and we actually, as a fund manager, we actually see this when hedge eye designates something as a buy for the community, we can actually see those flows hit ETFs, stocks, etc. We can track those types of dynamics, and everybody working together as a team can create conditions that actually become somewhat self-fulfilling, driving prices higher. Unfortunately, it can create slippage in models, etc. But the biggest thing that's actually happening there is that people working together are actually changing the path of the market. The exact same thing happens with all the Vanguard investors, right? They individually don't amount to a hill of beans, but together they're like a termite colony, right? They can move mountains effectively. And when you aggregate it all into a single fund or to a single strategy where everyone is doing the exact same thing, it creates conditions under which you can very quickly clear out the order book. I wish we had the chart that showed the front of book liquidity for the S&P 500. We'll bring that into the next one to discuss it. But effectively, if you think about what's happening as groups gain in size, they're overwhelming the local liquidity, almost back to that zero data expiry option dynamic, pushing us outside of it, causing a self-fulfilling move in price. That's inelasticity in a nutshell, right? The second thing, though, that happens is when you think about the economic definition of inelasticity, it literally means how much does supply change or demand change for a change in price. Most of us are bargain shoppers. We go to the grocery store, we see that steak is on sale, we'll buy more of it. We go to the grocery store, we see that chicken is no longer on sale, we'll buy less of it. Perversely, passive vehicles, particularly those that are weighted on a market cap basis, do the exact opposite, right? The price of steak goes higher, it becomes a larger potential portion of the purchasing basket. It's presumed that the price of steak is inevitably correct, and therefore you should buy it in a higher proportion than you would otherwise, right? That's the dynamics that create this dominance of momentum, et cetera, which is another symptom of inelastic markets. Prices rise, the rise does not lead to a reduction in demand, therefore prices rise even more, right? These are all characteristics and features of the market that we've seen over the last several years that seem to defy common sense until you actually recognize it's just an algorithm. That's just how these things are actually programmed to behave. And again, part of the reason why we try to pay so much attention to it. When we talk about the growth of these types of vehicles, this is pulled from a slide that I give on a regular basis. But if you actually look at where we were, I roughly started my career in 1992. At that point in time, passive was less than 2% of the market. It was actually around 1% of the market. By 1994, passive had grown to about 2% of the market. That's where we started to see some serious regulatory changes that favored the growth of passive, including allowing passive funds to utilize leverage when other mutual funds were not allowed to. That allowed them to trade in futures. And today we're at a point where it appears that somewhere north of 40% of all assets that are currently invested in the market, and this is not just index funds, et cetera, it's also index funds, futures, commingled trusts, separately managed accounts that are managed in a manner to mimic an index, et cetera. It appears that north of 40% of the market is passively managed. As a result, the market itself exhibits an incredible increase in inelasticity that has changed significantly versus where we were over the past, certainly when my career started back in the Stone Ages.